Why not?
You're staring at your banking app at 2 a.m. You're doing all the mental math, trying to figure out where the money actually went, and realizing that despite working harder and earning more than you used to, you're just not getting ahead. It's a really universal, quietly terrifying feeling. On Fair
I feel like
Insight,
it's
we
like
usually talk
loading.
about how money really works, but this part, most people ignore it. Sounds
Sounds
normal, right? Well, it's not. We are deeply conditioned to believe that just increasing our income is this magic bullet that solves all our financial stress. Make more money, fix the problem. But the reality? The reality is actually much darker, and it's literally built into the very structure of our economy. So let's dive right into this contradiction. There is a massive gap between what people say and how they actually live day to day. Look at the reality here. 73% of adults report they're doing okay financially. But beneath that surface level comfort lies a pretty shocking hidden truth. 37% of Americans would actively struggle to cover a mere $400 unexpected expense. Just a tiny bump in the road and the math breaks. And this lack of preparation, it isn't just some personal failure. It is a systemic feature. Think about this. Just over a third of the low-wage workforce, about 36%, actually have any emergency savings at all. And there are these massive disparities across racial lines and family size. White workers, workers without children, and men are noticeably more prepared. The system is fundamentally skewed right from the jump, making it incredibly hard for specific groups to ever build that initial safety net. Consider the lived experience of someone like Luis, a fast food manager from Philadelphia. He did everything right. He worked his way up from $7.25 an hour. He got the promotion. He even took on a second job. But his reality is stark. He said, "Even now, $15 an hour isn't enough. I worried, what are my children going to live off in the future?" When your absolute baseline costs consume everything you make, the math simply never allows for savings. And when that math breaks, and let's be honest, it always does, it shatters fast. A sudden car repair or a totally random medical expense instantly spirals into serious bill payment difficulty. Over 58% of people who face a sudden medical shock struggle to pay their regular bills just months later. It instantly triggers negative cash flow, drawing down whatever tiny reserves might exist, and forces vulnerable families into making impossible, absolutely desperate choices. Now, this vulnerability isn't just an American problem, by the way. It is a global trap. In a fascinating study out of Indonesia, researchers found that when lower-income households face this exact type of financial distress, they're often pushed past their own limited savings or even local pawn shops. Instead, they end up choosing illegal, astronomically high-interest predatory loans just to survive the week. It's a cycle mathematically designed to keep you permanently underwater. But here's the part nobody talks about: the six-figure trap. You might think that making, say, $300,000 a year magically makes you immune to all this stress. It really doesn't. High earners are simply running on a much, much more expensive treadmill. They're dealing with the exact same illusion of wealth, just with a different set of members on the screen. High earners get entirely drained by two invisible forces. First up is the education tax. That's the heavy, six-figure student loan debt you had to take on just to get that high-paying job in the first place. Second is the geography trap. You move to a massive tech hub like San Francisco or New York for the opportunity, and suddenly you're forced to neutralize $100,000 of your salary just to cover the wildly inflated cost of living. So yeah, you make more, but you are absolutely forced to spend more. Then comes the final nail in the coffin: the peer pressure ecosystem. Aggressive spending just becomes your baseline to fit in with your colleagues. The $100,000 car, the exotic vacations, it literally becomes expected. But consider the two paths in front of you. Option A gives you the look of wealth. Option B, the paid-off Camry, gives you actual wealth. So which one are you actually choosing? A or B? Be honest. Drop it in the comments. To truly understand why we're all feeling so stuck, whether you're making minimum wage or multiple six figures, we have to look at the macro-level systems measuring social mobility. Specifically, there's this concept called intergenerational elasticity. Basically, this is the percentage of income difference between families in one generation that persists into the next generation. Simply put, it is the literal measurement of how stuck you really are. And honestly, the data is incredibly sobering. Right now, the ratio between the average income of the top 0.1% and the bottom 90% in the US has pretty much returned to Gilded Age levels. The United States and the UK pair high inequality with remarkably low mobility. If you start at the bottom or even right in the middle, the system creates tremendous friction to keep you exactly there, totally unlike the Scandinavian nations where mobility remains high.
So how do we fix this? Escaping this cycle requires rejecting the system entirely. You can't just earn your way out of it. You literally have to break the ecosystem. That means prioritizing emergency savings, maybe through automated workplace programs if you have them. It means defeating the geography trap by negotiating remote work or actually relocating to lower cost of living areas. And honestly, most importantly, it means accepting the discomfort of standing out.
The discomfort of standing out is the true price of actual wealth. Whether you are fighting to escape predatory payday loans or you're trying to break out of that six-figure peer pressure trap, you have to consciously choose to stop feeding the ecosystem. You have to be willing to look a little less successful on the surface so you can actually be successful beneath it. So the crucial question I want to leave you with is this. Are you building a future or are you just paying for the present? If this realization changed how you look at your own bank account tonight, hit like, drop your thoughts in the comments, and subscribe so you don't miss the insights that actually protect your wealth. This is Fair Insight. See you in the next explainer.
You know that feeling? It's late, you're on your phone, just kind of scrolling through your accounts, and you feel this disconnect. The news is screaming one thing, but the numbers right there in front of you, they're telling a totally different story. That little gap between the story and the reality, it's a space most people just ignore. And on Fair Insight, where we usually talk about how money really works, well, this part, it's the only place that actually matters.
And that brings us right to the central puzzle. We're in early 2026, and by all accounts, this is supposed to be crypto's victory lap. So why does it feel like you're just treading water, like your portfolio's completely stuck? What is really going on behind all those headlines? Let's get into it.
On one side, you've got the headlines, and man, they look good. You've got a crypto president, you've got these landmark pro-crypto laws getting passed. The US government is even creating a strategic Bitcoin reserve. It's this perfect storm of good news. But then, you look at the reality. Traditional stocks are absolutely smashing records, while crypto sentiment is down in the dumps at extreme fear. And your own digital wallet, it's just sitting there, consolidating. This contradiction, this isn't just noise. It's the key to the whole thing.
To really get this paradox, first we have to appreciate the sheer force of the political wind at crypto's back. And this wasn't just talk. This was a legit tidal wave of policy. All of it was designed to make the US the crypto capital of the world.
And just look at how fast it all happened. I mean, boom, January 2025, a new working group on digital assets. The very next month, February, the SEC starts dropping those huge lawsuits against firms like Coinbase and Kraken. March, in a move nobody saw coming, an executive order establishes the U.S. Strategic Bitcoin Reserve. And by July, the Genius Act becomes law, the first ever federal framework for stablecoins. In just a little over 6 months, the entire landscape just changed.
So when you stack all that up, right, the bull case seems like a slam dunk. You've got political will from the very top, regulatory roadblocks just disappearing, the government itself basically becoming a hodler, and actual legislation providing clarity. It was the perfect setup for a truly historic crypto rally.
But here's the part that is so confusing. The market news for nothing. The price just isn't moving. So why?
You know, this quote from Pinto News just nails the feeling perfectly. Participation without acceleration. It means people are active, right? The community is buzzing, there's all this energy, but none of it is translating into upward price movement. It's exactly like an engine revving really, really loudly, but the car is stuck in neutral. The answer isn't in the headlines. It's in the hidden system that actually drives where the money flows. This isn't about good news versus bad news. No, it's about two fundamentally different bets that the big money is making right now.
Okay, so first you have what's called the confidence trade. That's the stock market right now. It's a bet on stability, a bet on predictable policy, and a belief in the strength of the existing U.S. economic system. When the main story is America is strong, capital naturally flows into the assets that reflect that story.
And then there's the pro-risk asset. And this is how large-scale capital, the big players, still see crypto. Despite all those positive headlines, they see it as an asset class that's super sensitive to big economic shifts and uncertainty.
And when things feel a little unsettled, the priority for those big investors isn't chasing massive gains. It's protecting the capital they already have.
Seems so positive? Well, they're creating massive, rapid change to the financial system. And for the big, conservative money, the kind of money that actually moves markets, rapid change, even good change, equals risk. They're just sitting on the sidelines, waiting for all the dust to settle before they commit their trillions.
So what does all this mean for you? You know, sitting there looking your phone late at night. It means you have to get really clear on which system you're actually betting on.
So which one are you actually choosing? Is it A, the stability of the current system? Or is it B, the disruption of a future one? Be honest with yourself. Drop your answer in the comments below. There's no right or wrong answer here, but knowing which game you're playing, that's everything.
And let's be really clear about something. That feeling of confusion you started with, it's not some personal failure. It's a perfectly rational response to watching a market get caught between a really powerful political story and its own deep-seated financial structure. Understanding why the market is behaving this way is so much more powerful than just trying to guess what it's going to do next.
It all just boils down to this one question. When you invest, you're not just buying an asset, you are buying into a story. The real question is, which one are you choosing? The story of stable preservation or the story of volatile creation? Understanding this difference is exactly how you navigate these confusing markets without getting totally lost. If you want to keep digging into the systems behind the headlines, make sure you follow Fair Insight. It's the best way to avoid the mistakes that come from only listening to the narrative. This is Fair Insight. See you in the next video.
It's late. You can't sleep. So you do that thing we all do when the house is quiet and our thoughts are loud. You grab your phone, right? The screen glows in the dark, and you open up your banking app. You're not really looking for anything specific. You just want to see the number, that little bit of proof that you're on the right track, that you're being responsible. And there it is, a nice, solid number, and you can finally breathe. Just a little. It feels good. It feels safe. Like a wall between you and whatever chaos life might decide to throw at you next.
On Fair Insight, we usually talk about how money really works. But this part, this little moment at 2 a.m., this is where a huge misunderstanding lives. And it's a part most people completely ignore because that feeling of safety is so comforting, but it's hiding a pretty dangerous truth. So let me ask you a question that might actually be worth losing sleep over. Your money is safe, sure, but is it growing or is it silently, invisibly shrinking every single day? All right, let's get into this that's constantly eating away at the real value of every dollar you've saved. And look at this. This is where it gets really clear. Your savings account might be paying you, maybe 0.5% in interest, but if inflation, the cost of everything, is going up by 2.5%, you're actually losing 2% of your money's power every single year. Your balance goes up a tiny bit, but what you can actually buy with it goes down. And meanwhile, the stock market, on average, has grown by about 10%. That gap, that's the difference between falling behind and getting ahead. The SEC puts it so simply, it's brilliant. Imagine you save $1 today, and it can buy a whole loaf of bread. That feels responsible. But what if, years from now, that same dollar can only buy you half a loaf? Was that really the safe choice? This, right here, this is the hidden risk of playing it too safe. So this brings us to the most important point of all. Saving and investing are not the same thing. Not even close. They're two totally different tools for two totally different jobs. And confusing them is one of the biggest financial mistakes anyone can make. I absolutely love this analogy. Think about it. Saving is like taking your apples and putting them in a cool, dark cellar. You're just trying to preserve them to keep them from going bad for a little while. But they're never going to multiply down there. Investing, though, that's taking the seeds from those apples and planting them. It's about growing whole new orchards for your future. And this chart breaks it all down perfectly. Saving, that's for your short-term goals. An emergency fund, a down payment on a car, stuff you'll need in the next few years. The goal is just preservation. Investing, on the other hand, that's for the long haul, 5 years or more. It's for the big stuff, like retirement. It's where you need your money to actually work for you, to grow into something much, much bigger. So, take a second and be honest. With the money you've set aside for your future, what are you actually doing? Are you storing apples, or are you planting trees? Let me know in the comments. No judgment. I'm just curious. Okay, now for the exciting part. Let's talk about how wealth is really created. It's not about some secret stock tip. It's about using a force that is way more powerful than inflation. This force is called compound interest, or compounding. So let that process keep going for 30 years. That single $1,000 becomes more than $17,000. That's not magic. That's math. That's the mind-blowing power of planting a tree and just giving it time. This is how you build real, lasting financial freedom. Okay, I get it. The numbers are convincing, but the how feels intimidating, right? Complicated? Well, here's the other hidden truth. It's not. The mindset of a successful investor isn't about being a genius. It's about following a very simple, very boring blueprint. The investment giant Vanguard boiled it down to just 4 goals. Why are you even doing this? Second, create balance. Don't put all your eggs in one basket. Third, keep your costs low because fees will eat your returns alive. And fourth, this is the hardest one for everybody, discipline. You have to stay the course even when the market gets rocky and your emotions are screaming at you to sell. And that second one, balance, is so terrified of seeing our account go down, even temporarily, that we choose an option that guarantees we lose purchasing power over time. And that is the real takeaway here. The biggest risk you face isn't losing some of your money, it's losing your time. It's waking up in 20 years and realizing you missed out on 2 decades of growth, all because you were too scared to start. Look, understanding this difference is one of the most powerful financial realizations you can ever have. If this explainer helped you see things a little more clearly, do me a favor and like it so you can find it again, and make sure you subscribe to Fair Insight so you don't miss the next one. This is Fair Insight. See you in the next video. You know that feeling, right? You're staring at your banking app at 2 a.m. You're doing all the mental math, trying to figure out where the money actually went, and realizing that despite working harder and earning more than you used to, you're just not getting ahead. It's a really universal, quietly terrifying feeling. On Fair Insight, we usually talk about how money really works, but this part, most people ignore it. Sounds normal, right? Well, it's not. We are deeply conditioned to believe that just increasing our income is this magic bullet that solves all our financial stress. Make more money, fix the problem. But the reality? The reality is actually much darker, and it's literally built into the very structure of our economy. So let's dive right into this contradiction. There is a massive gap between what people say and how they actually live day to day. Look at the reality here. 73% of adults report they're doing okay financially. But beneath that surface level comfort lies a pretty shocking hidden truth. 37% of Americans would actively struggle to cover a mere $400 unexpected expense. Just a tiny bump in the road and the math breaks. And this lack of preparation, it isn't just some personal failure. It is a systemic feature. Think about this. Just over a third of the low-wage workforce, about 36%, actually have any emergency savings at all. And there are these massive disparities across racial lines and family size. White workers, workers without children, and men are noticeably prepared. The system is fundamentally skewed right from the jump, making it incredibly hard for specific groups to ever build that initial safety net. Consider the lived experience of someone like Luis, a fast food manager from Philadelphia. He did everything right. He worked his way up from $7.25 an hour. He got the promotion. He even took on a second job. But his reality is stark. He said, "Even now, $15 an hour isn't enough. I worried, what are my children going to live off in the future?" When your absolute baseline costs consume everything you make, the math simply never allows for savings. And when that math breaks, and let's be honest, it always does, it shatters fast. A sudden car repair or a totally random medical expense instantly spirals into